Mic check.
Yeah. Yes, sir.
Alright, I didn't know we start early.
Yeah.
Oh, okay. So we're gonna call it, bro.
What we gonna call it?
Yeah.
I was thinking adding color to the market.
Word. Let me tell you what I'm about to call it, bro. I'm about to call that shit stocks play. You know, he's making a play. You know what I'm saying? With the stocks.
In the stocks.
Yeah.
Yeah.
You gotta understand.
Oh my god.
Yo, what's good? Welcome back. Episode 4, High Yield Productions. And we're gonna title this one, Bringing Color to the Market. Yeah. So today we're gonna be talking about stocks. We're gonna be giving you part 1 of this stock journey as well. And we're gonna be letting you know beginner tips on how to get into the stock market. A little bit of what we know, what we studied, and what we've done ourselves. You know what I mean? And I want to make it clear that we are not financial advisors. We just, giving out tools and tips to inspire the next person to maybe want to jump into trading stocks. You know what I mean? And you do with this information, do whatever you fit need. You know. Whatever needs fit, you know what I mean?
Whatever needs fit.
I got the bloopers for days.
Yes, bro. We always gonna have them.
For sure.
But yeah, though, just to piggyback off what my boy said, though, basically, it's gonna be a 2-parter. You know what I'm saying? We're gonna split this thing up. We're gonna give you the intro to stocks, how to play them, how to get into the game, the basic things that you need in order to at least just get your foot in the door. And then we're gonna open up a little bit more, part 2, you know what I'm saying, let you know plays we will make, companies to get into, different terminology when it comes down to the stocks, so this has been a highly requested episode.
Yeah.
You know what I'm saying? People be wanting to get our gems all the time now, so definitely gotta let y'all know what time it is, man. You know what I'm saying?
For sure. And since it's been so highly requested, them views, them likes, them subscribes, they gotta go up. You know what I'm saying?
Definitely got to get those up, though.
For sure.
So, in order to do that, you know what I'm saying, we definitely gonna make this more entertaining as well. You know what I'm saying? As you see, my boy sipping the yak. we gotta get
Kool-Aid.
We gotta get active, man. Listen, Mama, I'm sorry. Nah, but for real though, man.
Yeah, man. For sure.
Get a little parched up here, but yeah. So get into it. You want to start?
No, you can go ahead, bro.
All right. So generally, the basic aspect of stock market is companies go public. You can, as a consumer, buy a share of the company. So knowing companies, basically. So the stock market is a share of a company. So what a stock is the share of a company. Let me do that. So the stock market is a total overall look of what those company shareholders are, you know what I'm saying, how things fluctuate.
Yeah.
In order for stocks to go up, more people have to invest. Things have to change within the company. Some companies even allow you to be a part of their boardroom type meetings, send you updates on what's going on with the company, let you know when your dividends are coming in. Dividends, we mentioned that before, but it's where the high yield come in at, you know what I'm saying? The dividends or your dividend yield percentage is what the company ends up paying you back. Some pays monthly, some pay annually, and some pay by the quarter. So everything is broken up into quarters. It's 4 quarters in a year. And yeah, you know what I'm saying? In order to follow trends, some people like to read charts, other people just like to go with facts and history. You know what I'm saying? So
for sure.
Generally the best thing you want to look for as far as hindsight when you're looking at a company, longevity. You know what I'm saying? It's a key word, longevity. Longevity is a major key because you will rather invest your money in a company that has steady growth over 20, 30, 40-year time, as opposed to a company that's only been around maybe 10 years. They show slight growth at different times. You look into the company more, see what their products are, see what they offer, and see what they have as their future plans. All these things you can do. You know what I'm saying? These companies, they're public. That's what comes with being public. You know, this information is for the public. Yeah. So when you looking to invest, you go look into these companies, see what they offer, and see if they offer what you like. I would start with companies that you already know, like for an example, North Face, or just keeping it simple. You know what I'm saying? Verizon, retail stores like Walmart, Target. You know what I'm saying? Do your research, of course. Like, we're gonna keep the disclaimer in there, but do your research. I'm gonna keep reiterating that because
that's what it's gonna take.
Right. You know what I'm saying? Don't invest in those stocks that you're not 100% about, period. Right. You know what I'm saying? But it's also a way to somewhat make your money back off of owning a part of that company. You feel what I'm saying? Right. If you shop at Nike a lot, why not own a couple hundred shares of Nike so you can get that money back in return? You know what I'm saying? They're going to show steady growth. They're always going to be dropping new things. They're getting ready to change the sneakers app. They just closed that. They just closed down that deal with Foot Locker, so it's open more sneakers other places, which is gonna make them more of a top of the line brand when it comes down to getting their sneakers. That's all for profit. Yeah, it's all for profit.
For sure.
So,
and touching on doing your research and checking the history and all of that, don't always go with what's in the hype. You know what I mean? Daggone high yield productions. Go with us though. Hype.
Yeah. We gonna let you know.
We gonna let you know, but
we gonna let you know barbecue a meal, dude. Straight up.
Boy country, man. But yeah, man, don't go with the hype, you feel me? Because, you might jump to that stock thinking that it's gonna, do these numbers or whatever, because everybody's jumping on it, everybody hopping on the wave, and it done grew so quick, but it can drop just like that. For instance,
I knew you was finna use that. I knew you was finna do that, bro. I was waiting on it.
When Dogecoin was popping, I hopped on it. I bought 200 shares. Daggone, dropped that bread. It was probably like 9 cents. Daggone, it made me some profit, and I was like, you know what? I'm gonna sit on it. You know what I mean? It only made me a few hundred more. I'm gonna sit on it. You know what I mean? Daggone, next few weeks later. You know what I'm saying? Like,
and Dogecoin is a cryptocurrency, so they just let you know when I was talking about volatility, like they are extremely volatile. Like even stocks are as well. Like
for sure,
for real.
Yeah, and go with the hype. You know what I mean? Because you go with the hype, you might lose out in the long run. Like my boy was touching on, you gotta check on things that have good longevity on different apps like Robinhood and Webull. You know what I'm saying? You can break it down. You can check it monthly. You can look at what it's done in the past over the year. You can look at what it's doing right now, what it's projected to do. How much it's grown and dropped within those months, within the year, within the weeks. You know what I mean? And also, also check on how it's doing when the market opens up. You know what I'm saying? Or when it closes. And what you want to also do when it comes to researching the products. What I do, I research products I use every day. You know what I mean? My favorite products, or some that I might want to own one day. You feel me? Because I look at the stock market as another savings account. You feel me? Yeah, because sometimes you down bad. You feel me?
You get a higher percentage off of that type of savings account.
For sure.
You know what I'm saying? Definitely a higher percentage.
And like with Cash App, you can get like a cash card. With some of these apps, they can send you a card too. And you can use that card, like debit, credit card, and you won't have to wait for the cash to be dropped into your bank account. But the best thing to do is to keep on to them stocks. You know what I mean? Because longevity builds equity. You want your portfolio to grow. You want the dividends to look good in your portfolio, and you also want the equity in the long run because our bias is. We're building generational wealth. You know what I mean? We're trying to, buy a stock low today, and then 10, 20 years later, had that bread, 10 times fold. You feel me?
Yes, that just go back to your point that you already made about don't follow the hype. You know what I'm saying? In other words, find your get in point. One thing my boy Wall Street Trapper, teaches is you got to find your price point. Him and Ian Dunlap, you feel me, the master investor. Yeah. Like find your price point. So look over a 5-10 year span, see where the highs and the lows are. Typically, you want to look at 52-week highs, 52-week lows. You know what I'm saying?
Sure.
And you find you a good median. So if you do it over the 5-year span, you look over what the highest number is from the 5-year span versus what the lowest number is from that 5-year span, and then you base your number based on that. You know what I'm saying?
Yeah.
I'm gonna go back and touch on what we talked about before, what I mentioned before with fractional shares. You feel me? So I know a lot of people get misled looking at the stock market, and it looks crazy, and certain stocks are $400 and $500 or whatever. You know what I'm saying? Even stocks that are over $100. If if you're on a low budget, best thing to do is buy a fraction of a stock. You know what I'm saying? You got other platforms as well. As well as Webull and Robinhood and stuff. You got TD Ameritrade and several others. So they all do things a little bit differently, but overall the aspect is still the same.
Yeah.
So you know what I'm saying? That's really the best way. And looking at companies that have high market caps is really straight too. You know what I'm saying? Like looking at how much money a company has to play with, you know what I'm saying, as well as where the stocks start and stop at. Lord, I can't get that out. But yeah, you know what I'm saying? Like so yeah. So you want to go into the ETFs?
Yeah, for sure. ETFs basically are buying a sector of stocks. You know what I mean? All the stocks in the stock market have to be in a category. So every category.
We sleepy, y'all.
Yeah, for sure. We work third shift.
Yeah.
10 to 6:30 a.m. It's what 12:30 now. And we up dropping this knowledge for y'all. You feel me?
Facts.
High yield productions.
Yeah. Low key, that's why we splitting it up. But you know what I'm saying?
Yeah, for sure.
You feel me?
We got real life to live too. We ain't at that
Yeah.
we ain't at that level yet that we trying to get to, you know what I mean? But once we get there, you'll see.
You feel me?
For sure. But yeah, with the ETFs, it's like buying a sector of a stock. So every stock has to fit into a category. I think it's 11 categories
Yeah.
that, is in the stock market. So let's say like you want to go with sodas. That sector or the ETF is sodas. So whatever like that brand, whatever that sector, like Pepsi, you got Coca-Cola, you got daggone anything else.
Mountain Dew,
Sprite,
yeah,
you know what I'm
Dr.
saying?
Pepper, you know what I'm saying?
You feel me?
They're all gonna be categorized in
that one sector.
One ETF, you know
feel
what I'm
me?
saying?
Yeah, for sure.
Or one sector, and then you can take a few of those, put them into an ETF. You feel me? It just categorizes them. You know what I'm saying?
Right, for sure. So like basically what I'm saying is it's just like if you was to go to the store. So let's say you go to the store, you go to an aisle, and aisle sell like chips or cereal or something like that. It's different brands of cereal, it's different brands of chips. You go in there, you don't know which one you want. So you just say, man, I'm gonna buy all of them. You know what I mean? You got the bread like that, you gonna buy them all. You feel me? So you buying that whole aisle of all of that, all of the chips, all of the cereal, is your ETF, is your sector. You know what I mean? Because you got the Doritos, the Lay's, etc., and they all fit into the category of chips. So with that, it comes, a percentage. A percentage is taken out by whatever app you use. If you got a stockbroker, if you got somebody to just, manage your stocks and your funds, then what that is, every $1,000 you make or $1,000 you putting up, they're getting a percentage of that. So let's say like it's 0.7. That on 0.7 and it's $70 of that 1,000, that you earning from your stocks that they're getting. It's best to stay below 1. You know what I mean? Because 1, your percentage starts getting a little bit too high. It's just like when you get an interest loan, I think. You know what I'm saying? Because with an interest loan, you want your interest to be low.
Because that's with anything credit wise.
Yeah, for sure.
Anything that involves interest, period, you want your interest to be low.
Speaking of credit, stay tuned for the credit tip of the week. Yeah. Yeah, my bad, bro. But yeah, what you saying?
But yeah, though, that's it. I was just saying, you know what I'm saying? Interest, you always want interest to be low, period.
For sure.
But you want your interest to be high when we go into that savings aspect of it, because the higher interest you can build on your money, the more money you can have. So the same way a bank or traditionally a 401k or something like that is going to only add 1% to your money, or they're only going to match a certain dollar amount.
For sure.
A stock can go from $100 to $1,000, and you profit off of that based on however many shares you have, as well as what the stock went up for. So I would get a little bit. Only thing I would change is with the ETF, because you can have multiple ETFs within one sector. So you know what I'm saying. Let's say if it's real estate, it's a whole bunch of, we're gonna use the sodas or the chips or the cereal. The whole aisle, but let's say
more than 1 hour.
The ETF is, I mean, the sector is the chips, right?
Right.
But the ETF might only be the Lay's, Doritos, your top brands. You might have an ETF with your top brands. That one might be a little bit higher. Then you might have one with a little mixture. You know what I'm saying?
Okay.
You know, your Utz and your Lay's. You know what I'm saying?
Right,
Some people prefer one over the other.
Right.
But they all fluctuate within the ETF based on who's doing the best. You feel what I'm saying? So that's why it's good to use ETFs as a great starter. You know what I'm saying? If you're getting in the game, because you can get all the top stocks under one roof. You know what I'm saying? Keep feeding that, and as they go up, you'll go up. And if one of them was to misperform based on how you play it, let's say one of them was to be down. Let's say Utz will be down.
Right.
If Lay's does tremendously and Doritos does tremendously, it's gonna kind of balance you out. You know what I'm saying? As well as the other stocks, as long as they stay average. You know what I'm saying? Of course, if all of them go down, the ETF is gonna go down. Right. But once again, that's all about how you play it. You know, knowing what stocks do what, knowing what companies do what, and what companies are good counter reactors to other companies, if that makes sense.
And that's touching back on checking the history. You know what I'm saying? On the app, or you know, if you checking it, I know some people still use newspaper. If you, for my older people, if you checking your stocks or whatever, they're gonna check their history, and then you can see how it's been doing in the past year, and that will help influence if you should, you know, put more money, or if you should, you know, see which ones are better to include into the ETF. Also, with ETFs, it's cheaper. It's a cheaper route. It's cheaper than getting you know,
all those individually. You
exactly.
know what I'm saying?
Yeah,
for sure.
So yeah, I know a lot of people. You know what I'm saying? Like, they're wondering, you know, how they can get in the stock market. You know, they might not have enough bread. They might not be doing as well as others that's hopping in with thousands of dollars. You know what I mean? But really and truly, you ain't gotta start with a lot. You feel me? Like I was saying before, with the Dogecoin, I dropped some bread in there. I'm thinking I'm gonna have to drop a lot for it to make a decent amount of profit. But really, I only dropped 200. I dropped 200. It was 9 cents a share. You know what I'm saying? You do the math. It grew. When it grew, you know, it made me quite a bit. You know what I'm saying? I don't really like disclosing how much money I be having. You know what I mean? Y'all might try to rob me.
Yeah, ain't no pocket checking.
You feel me? So for sure, like, it grew, but also it dropped. You know what I'm saying? So don't keep believing the hype. You feel me? But other than that, like, let's say, like my boy said, you get a partial share. Let's say you want some Bitcoin, because Bitcoin, it goes up a lot, it goes down a lot. But when it bounced back,
at one point, Bitcoin was $70,000. You know what I'm saying?
For sure. It made a lot of people millionaires.
It's about 40,000 right now.
Yeah, and I know, like, maybe a few weeks ago, I'm gonna say a few months ago, it's like 35.
Yeah.
So it jumped. You know what I'm saying? It jumped up that 9 grand, and you know, like, it made a lot of people profit, even the people that got the partial shares. You know, you can start out with $1. You feel me? That dollar could grow if you get a stock that grows tremendously over an amount of time. That's why it's good to do your research. You know what I mean? Do your research. Don't just take our word for it. Check into them stocks. Check into how they fluctuate, go up, go down. They're gonna compare them to other stocks, and really and truly, you know, like I was saying, it was a savings account. It's also a way you can pay for other stocks. You feel me? So let's say you grew a lot of money on this one stock, and you got other stocks that's doing well too. and you want to invest in them, but you ain't got no pocket change to just be dropping on some stocks right now. You can move that money around. You can take that money from this one stock, move it to the other stock. When that one jump, boom, do it again. Or you can buy more. Keep investing. Keep putting money in. Keep that longevity going because you're going to want that equity. The equity going to pay off. Because just like...
The more shares, the higher your equity.
Exactly.
10,000 shares of the stock market can make you rich.
For sure.
Period. So however you want to do that math, 10,000 shares is the optimal goal. You know what I'm saying? You want to pick you a sector, study it, learn it, and go in with it.
Yeah. And one more thing. When you do the research, let's say Tesla, their batteries, Honda, their chip, you know what I mean? They really need that or whatever. So the stock and them parts are gonna go up. You don't have to just invest in Tesla or the actual company. You can invest in the parts that make whatever type of product you like. So let's say Apple, you want to invest in the screens. People crack their screens a lot. You want to invest in the little charger port. I know I had a lot of phones where I messed up the charger port. You know what I mean? The chargers, anything. And you can see your stocks grow based off the parts, rather than spending all this bread on a stock that costs a whole lot. If you're a little shaky about jumping into the stock market. Once again, trial and error. Like everything else that we've been dropping for y'all, you got to try it out. That's why it's better to go the safer route. You know what I mean? It's better to actually look into stocks that you can afford, money that you can afford to lose and use. And really and truly, right now, I'm saving money so I can drop what I feel like I need to drop on some stocks that's gonna do good. Because rather than before, where I was just putting in a little bread at a time, I can drop this whole summer bread, and that gonna maybe jump up to the amount of money that I want to be. But it's all based on, you feel me? For sure.
Only thing I'm gonna add to that, you know what I'm saying? We're gonna close off this part one. Yeah. There's different ways to invest. You feel me? Figure out which way works for you. You know what I'm saying? He doesn't like the smaller way. You know what I'm saying? Me personally, I like the smaller way. And the reason why I like the smaller way is because it gives you more consistency as far as the market is concerned. You know what I'm saying? It gives you a way to keep up with the market. Sometimes when you're not investing, you tend to not pay attention to it. Right. You know what I'm saying? So whatever you start with, I would stay consistent with that. So if it's 200, every month you need to have 200 put to the side. You know what I'm saying? To invest. Figure out what stocks, if they done grew, like he said, take your profit out, put your profit into whatever other stocks are in your portfolio that you've been watching. And you know what I'm saying, and just run it up like that. So, figure out which way works best for you, create your own blueprint, and then rock out, man. You know what I'm saying?
Yeah, and also, I know we're closing out, you know what I mean? But it's just popped in my head, because I want y'all to know this too. A lot of people feel like because the stock market drops, that it's bad. It's a bad thing. I mean, yeah, you might lose a little bit of money, but their money gonna come back, you feel me?
It's really discounted. You know what I'm saying? That's how I look at it. The stock is going on clearance. You know what I'm saying? My boy Wall Street Trapper says that too, you feel me?
Yeah.
When the stock market goes down, that's the time to invest. You feel me? Like I said, find your price point. You never want to invest at the 52-week high. You never want to do that. You know what I'm saying? You're only gonna lose money that way unless the stock is guaranteed to go up from the time you invest. You feel me?
For all the couponers out there.
You know what I'm saying? So, invest in the stock at a good time. If the stock is $200, I would really wait till it's about 50% less. You know what I'm saying? Sure. If you can help it. You feel me?
Yeah.
About 60, 65, 70 is still good. As long as you know the growth within the company, you feel me? So if it's a company like Microsoft, Apple, you know what I'm saying? Very smart to do that.
Because you know it's gonna bounce back.
Facts.
Yeah, for sure.
Facts.
But y'all stay tuned. Part 2 coming soon. High Yield Productions. Part 1, bringing color to the market. Peace.